So I was having this conversation with a friend the other day, and she mentioned, don't you just start seeing clients when they're sort of 55 plus? And I think that's a pretty big misconception when it comes to financial planning. I know there are lots of advisors around town that only see retirees, but we're a little bit different. We start seeing clients sort of late 30s, early 40s on an ongoing basis. So let's imagine you're sort of late 30s, early 40s. You may be on good incomes, you may have some kids, got some super happening, got a house, got some debt and some equity building in that. Into the future, let's call it sort of 10 to 20 years time. This is sort of a financial freedom number where we want to accumulate some assets. So let's just, for round numbers today, let's assume we want a passive income of $100,000. So if we wanted $100,000 passive income in today's dollars, we'd need about $2 million in investment assets. Now, this calculation, it's based on if we want to maintain the real value of our capital over time. And that just assumes an 8% rate of return minus 3% for inflation. So we've got a real return of 5%. So you might have heard like the 20 times rule. So it's basically, you take your income times 20, you're going to get 2 million. Another way to do it is take this and then divide it by 5%. You're going to get the same number there. Not everyone wants to maintain the real value of the capital over time. Some people are happy to kind of spend it down, still leave quite a nice estate here. If you wanted to do that, you wouldn't times it by 20, you'd times it by like 18 or something, then it would still last 30 to 40 years. So what we do find is most people are not ever going to get anywhere close to that. What we find is, just with the stats that tell us that 80% of people end up on the age pension, your super will get you part of the way there. It might get you to say 1 million. That means there's still this huge gap here. So what we do is we help clients bridge that gap with really great strategies: investments, shares, property, super, cash flow, risk management, debt management, estate planning. You're going to get there. Lots of things are going to happen along the way as well. So you might move house, change jobs. Someone in the family might get sick. There'll definitely be a share market crash somewhere in the middle here. You might get an inheritance. So lots of things to navigate to get us up here. It's actually not a straight line. It's going to be something a little bit more like this over time. What we also need is to have some risk management in place. So we don't completely blow the thing up if something goes wrong along the way. That's where I think we add the most value for clients when they first start coming to see us, sort of late 30s, early 40s, when we've still got some time here. If we only saw people when they were 55 plus, they'd have to have done something like this for us to work with them past this point. Often people come and see us and it's too late. We can't help them unless they do something here already. So hope that helps.